The global financial landscape is undergoing a profound transformation. There's a growing recognition that financial activities must align with environmental, social, and governance principles. This shift signifies a move away from purely profit-driven motives towards a more holistic approach where sustainability is paramount. The insurance industry, a cornerstone of the global financial system, is facing a pivotal moment in this evolving landscape. The European Union's Sustainable Finance Disclosure Regulation, implemented in March 2021, is at the heart of this transformation. It's not just another regulatory hurdle for insurers to clear. The SFDR represents a fundamental shift in how the financial sector must operate. It compels a deep integration of sustainability considerations into the very core of business operations. This regulation is a clear signal that sustainability is no longer a peripheral concern, but a core business imperative. For the insurance industry, the SFDR presents both challenges and opportunities. It demands a reassessment of traditional business models and a proactive embrace of sustainable practices. Insurers who understand the transformative nature of the SFDR and adapt accordingly will be well positioned to thrive. Those who cling to outdated practices risk being left behind in a rapidly evolving market that increasingly demands transparency, responsibility, and a commitment to a sustainable future. At its core, the SFDR aims to increase transparency around sustainability risks and impacts within the financial market. It mandates that all financial market participants, including insurers, disclose how they incorporate ESG factors into their operations. This transparency is crucial for investors and stakeholders who are increasingly demanding sustainable investment options and responsible corporate behavior. The SFDR introduces a comprehensive framework with specific disclosure requirements at both the entity and product levels. Entity-level disclosures require firms to provide detailed information on how they integrate sustainability risks into their investment decisions. This includes disclosing the potential adverse impacts of those decisions on sustainability factors. Product-level disclosures focus on the ESG characteristics of financial products. Insurers must provide clear and concise information about the sustainability-related objectives and features of their products. This information must be readily accessible to clients and potential investors, both before entering into a contract and through regular reporting. Furthermore, the SFDR introduces the concept of principal adverse impact statements. These statements require firms to report on the negative impacts their investments have on sustainability factors, such as greenhouse gas emissions, biodiversity loss, and human rights violations. This level of accountability is unprecedented and underscores the seriousness with which the EU is approaching sustainable finance. While other financial sectors have been quick to respond to the SFDR, the insurance industry has been relatively slow to adapt. This complacency stems from a misunderstanding of the regulation's far-reaching implications. Insurers often view themselves as passive observers rather than active participants in the sustainability landscape. However, the reality is that insurers wield significant influence through their vast investment portfolios and underwriting practices. The SFDR shines a spotlight on these practices, exposing vulnerabilities that could have significant consequences for insurers that fail to adapt. Insurers manage trillions of euros in assets, making them some of the world's largest institutional investors. The SFDR subjects these investments to unprecedented scrutiny. Holdings in fossil fuel companies, industries linked to deforestation, or businesses with poor labor practices are no longer just reputational risks. They are regulatory liabilities. Similarly, insurers' underwriting practices have come under scrutiny. The SFDR recognizes that insuring high-risk industries without considering ESG factors can perpetuate harmful practices and expose insurers to long-term risks. Failing to incorporate sustainability factors into underwriting decisions could lead to increased claims and financial instability in the long run. The ESG data conundrum, a challenge for insurers. Balancing sustainability and profitability is like walking a tightrope. On one side, there are the pressing demands of environmental responsibility. On the other, the need to maintain financial performance. It's not easy, but it's essential. Every step must be calculated and deliberate. companies must navigate these challenges with precision and foresight. The stakes are high, but so are the rewards. It's a journey that requires commitment, innovation, and a willingness to adapt. In the end, those who master this balance will lead the way to a more sustainable future. Often unnoticed, the silent roadblocks in our journey towards transformation can be the most challenging. You see, these obstacles aren't always loud or obvious. They can be deeply embedded in our systems and processes, making them difficult to identify and even harder to overcome. But recognizing these silent barriers is the first step towards meaningful change. In today's fast-paced world, sustainability isn't just a buzzword, it's a strategic imperative. Companies that integrate sustainable practices into their core strategies are not only doing the right thing, but also positioning themselves for long-term success. It's about balancing profit with purpose and ensuring that our actions today pave the way for a better tomorrow. Sustainable finance serves as a moral compass in the financial world. It guides us towards investments that not only yield returns, but also contribute positively to society and the environment. By aligning our financial decisions with ethical values, we can drive progress and create a more equitable and sustainable future for all. The insurance industry stands at a defining moment. With the increasing impacts of climate change and societal shifts, insurers are uniquely positioned to lead the charge in sustainable practices. By adopting forward-thinking policies and innovative solutions, they can mitigate risks and support the transition to a more resilient and sustainable economy.